Hello and welcome to the show. We call it Molotsky on Money. What is this show all about? The clues are in the title. We'll be discussing money, specifically investment strategies, taxes, estate planning, insurance, and many other topics, all of it designed to help you and your family improve your overall financial picture. The Molotsky part of our title comes from our panel. Their name is Molotsky. Each week we'll have Stan Molotsky, president and founder of the SHM Financial Group, as well as Lee Molotsky, vice president of the SHM Financial Group. So stay tuned because we have valuable information on each show. Tonight, of course, is no exception that we hope everyone can benefit from. And tonight, as I said, Stan, is no exception. We got plenty to talk about. We always have plenty to talk about here on the show.
We can't quite squeeze it in that half
That's
hour.
right. We're going to try our hardest to get it all in here. But as part of your practice for overall financial planning, correct?
Correct.
There's a lot of things that you have. There's a lot of tools, there's a lot of things that you can help people understand this process a little better. Is it kind of what you do as part of the ongoing process?
It's part of the ongoing process. The thing that I've learned over the years is that obviously we don't know everything. We're far from it, but we have access to a multitude of different people, multitude of different entities that help us do the things that we do for our clients, from the legal aspect to the accounting aspect, to the investment aspect, to the fixed side, meaning insurances. All these kinds of things are all part of the total planning process that everybody has to take advantage of in their plan. And it's an ongoing process.
Right, and Lee, as part of this, it's not always just what you say. I mean, sometimes when you direct people, it's based on maybe a review or some kind of a guideline that you've given them to show them that what you say actually has some merit. Is that pretty much what you do along the way?
We follow an outline, a guideline, an outline of kind of our stress test, but an outline of where people are in their thinking. And then each quarter we try and review that with the individual client, whether it's a husband and wife or an individual person.
It's a plan. It's a plan, and it's an ongoing plan, like Lee just said, and it has to be adjusted every 6 to 12 months or modified based on what is happening. And certainly things happen so much faster today than they did way back, when I started my career in this business.
1958, right? We have to say that again, 1958.
What's interesting about that, we were talking earlier this evening about many years ago when we did a radio show, and we were talking about early parts of 2007, and there was no end in sight of where the market was going in early 2007, except we spoke on the radio many, many times in early 2007 about be careful as we enter into the latter part of 2007 on anticipation of not potentially what happened, because we didn't know it would be that severe, but sharpen your tools, sharpen your pencils, be careful with where we're going, redefine your risk tolerance. And at our quarterly meeting, we try and do that.
Well,
and why is that important? Because
that's the key, and leading into what we're going to talk about tonight, and part of what Stan and Lee do is help you understand why they're maybe recommending or talking about what you should do, and this is called the Rule of 100. Now, explain what the Rule of 100 is, and how does it fit into this, Stan?
Well, going way back, in the beginning of my career, there was no Rule of 100. It was called the Rule of 85.
And why was that?
Because you would take the person's expected maximum life expectancy, and then you would subtract their age from that, and that would be the amount that they should have at risk in their total portfolio. And then about the time when Lee came into the business in the 80s, then it became the Rule of 100.
Because the life expectancy was going up,
gradually
correct?
moving up.
Right.
And about 15 years ago, I said, we're not going to use the Rule of 100. In our practice, we use the Rule of 115. And it's the idea of you take 115, you take the person's age, 70, 80, 60, whatever it is, subtract that from, we use, the 110, 115. And that is the amount we feel should be in the equity markets, and then the balance should be in predictable, non-risk related kinds of
Okay,
things.
so we have a definition here so people can actually see this, and you just amended it a little bit, Stan, so you could substitute 100 for 115.
Whatever
Yes.
works for the person.
Okay,
Correct.
but basically it takes into consideration your age and investment time horizon to better define risk tolerance.
Correct,
That's
exactly.
pretty much what this is about.
Right, right, and the fact that people are living longer. I mean, you and I know, and Lee too, and people watching this show, 30 years ago, nobody knew anybody that was 100 years old. Today, everybody knows a half a dozen people that are 100 or are certainly in their 90s.
Yes.
So, I mean, as people live longer, the money has to last longer, and that's the critical part of planning in today's basic environment.
It used to be a lot easier in the fact that you would get paid to wait, and meaning you park your money in a CD for 5 years and you could earn 6, 7, 8, 9, 10%. No, way back.
Right, and you didn't have to do anything.
You didn't have to do it. You just waited, and okay, whatever happened. Nobody considered inflation issues. Now, with interest rates at the bottom of the barrel, you can't get paid to wait. You're not getting paid to wait. So it's really important to utilize this rule of 100.
All right, let's show, speaking of that, let's show what we're actually talking about using an example here. And again, you can substitute, because Stan had said you don't use 100, you use 110.
Well, we can use 100 for our purposes here.
Right, but basically what this would show them, and if we can put that next one up, Justin, where we show them a 65-year-old client, let's say he would have $100,000. Okay.
Investable
and he's
money.
65.
Okay.
That's $100,000 investable money. All right. What does he do with that?
Well, again, I'm, a stock market person. I mean,
Okay.
I grew up in that environment, and so I'm leaning more to the equity kinds of things as part of a total plan in a person's overall plan. Just that there are combinations of different things today that make a lot more sense than the straight equity side. So using the rule of 100, you basically say, okay, he's 65, a minimum of 35% of his assets should be in equity-related kinds of things.
And
Now,
we're showing that right now. So he should have, according to that, $35,000 in stocks and $65,000 in safe alternatives.
but there are also the 35,000 in stock based on where we are within the cycle. Maybe that 35,000 should not be in stocks per se, but in things that are linked to the markets themselves, which in turn would allow that person to have minimal risk on the downside, but still be able to participate on the market's movement on the upside. This has been one of the changes within the industry to allow people access to different kinds of things that make the most sense based on what they're trying to accomplish.
I just want to clarify. I think maybe I misheard you. It's a maximum of 35% exposure to the market.
Depending,
Approximately.
circumstances and
Again,
the
but
risk tolerance.
You take the 100 minus their age, and that's the approximately
That's the approximate,
maximum.
right.
It's a starting point.
It's a starting point for the maximum, though. You had said minimum. So I just want to make sure
But
we're on the same page.
if we use as Stan said, if we go to 110, so then you would be subtracting 65
So
from 110.
45.
So then you'd have a little more,
Yeah.
correct?
That's correct.
Exactly.
So that's not a hard and fixed number.
No,
No, just a
everybody's different.
guideline.
Everybody's different, and everybody's goals and objectives are different. And the more money that is available allows them to be sometimes more at risk or less at risk based on what they want to do for that money.
All right, more to talk about here on the show. It's Molotsky on Money. We are here every week at this time. Tonight we're talking about the rule of 100. And coming up, we're going to show you green money, red money. I mean, so many colors and a lot of good information. Stay with us. More to talk about with Stan and Lee Molotsky. I'm your host, John DeMasi. Coming back, more of the show after these words. Don't go away.
Join Stan and Lee Molotsky and their guests for their next series of all-important workshops. It's a unique opportunity for you to meet Stan and Lee and the SHM Financial Group, as well as have your questions answered. All workshops are complimentary and include lunch or dinner.
Throughout our working years, we accumulate as many retirement nest eggs as possible. The problem is, not much attention is given to the color of the eggs. Do you know how much of your assets should be allocated to each color? At our firm, we have a system that helps you allocate your retirement nest eggs correctly. We have a simple way for you to group your retirement assets into red, yellow, and green money. Give us a call today and we will help you sort and label your retirement nest eggs, giving you a clear picture of the color of your retirement.
Welcome back to Molotsky on Money. I'm your host, John DeMasi. We're discussing with Stan and Lee Molotsky tonight here on the show the Rule of 100. It's sort of a guideline as to how you can set up your financial plan. That's pretty much what we're talking about, right, Stan? It's a guideline. It's not fixed in stone,
Nothing
right?
is fixed in stone. Everything is a constant adjustment based on what's going on in the world and what's going on with the client or prospective client's life. Everything is constantly in motion. I mean,
All right, I want to ask you, and we're going to show this, safe alternatives and things that are in stocks which allow, I guess, for more growth. Your feeling is, and we were talking about this during the break, that with what you're getting in fixed instruments today, that's not necessarily the best move to make, is it?
No, it's not the best move, but at some point within the cycle, you want to have more in there to take advantage of what may be, a correction within the particular stock that you're looking at, or the mutual fund, or the process that you're going through, so that you want to have a certain amount of cash that would be available. But there are different programs that are available today that allow you participation in the markets, like we said before, without the risks of the market. And the beauty of a practice like ours, our job is to work for the client. We look at the client's goals, objectives, risk tolerance, what they're trying to accomplish, their health, and then we put together a plan. And it's an ongoing process, the plan. And because we're an independent entity, we do not have a fixed product line like a lot of entities do. And they're not saying anything wrong with that. It's just that when you have a fixed product line, you can't go outside that product line to offer alternatives and suggestions to the clients. We don't have that fixed product line. So therefore, we can pick from the universe to determine what makes the most sense for that particular client, and then constantly upgrade it, adjust it, change it based on what's going on. And like Lee said before, we try and meet with a client at least every 6 months just to go over what's going on, look at the plan, see how we can adjust the plan based on what's happening at that particular time.
So Lee, it's an ongoing process, and we wanted to show everybody, and you'll help us walk us through this, what we're talking about, green money, red money. We've done shows on this before, but green money is safe instruments versus red money, which is at-risk investments, and we'll show that in just a moment. But what are we talking about when we talk about safe instruments?
I was going to say, we talk about instruments that are principal protected in nature, in the fact that the principal can't go down no matter whether we see an inflationary environment, or we see high interest rates or low interest rates or stock market corrections. They're instruments that are protected from principal erosion. They may have other sorts of risks to them, but principal erosion is green money.
Right, and here we're showing it here.
There's no principal erosion.
On the safe investments, you see that they're checking, savings, CDs, treasuries, fixed annuities, money markets, and then red money is stocks, bonds, variable annuities, mutual funds, REITs. So back to what you were saying before, Stan, that example of the 65-year-old person, basically he would have 65% on the green side and about 35% on the red side, but that's flexible.
Sure, it's flexible based on circumstances and what's going on and a multitude of things, but that's a good starting point. You go from there and you look at what they're trying to do, you look at other monies, you look at other objectives, other potential expenses, and then you fit the particular situation to the particular client. And there are combinations of fixed related things that, in order to enhance returns, are fixed with their principal, but are linked to the market performances of whether it's the Dow, the Standard & Poor, the Russell, a European index, a basket of commodities. There's a whole multitude of different things that you could link the potential gains to and still protect the principal. These are relatively new.
These hybrid instruments, and we had that up there on the screen, hybrid instruments, and these are what you're talking about.
Exactly.
Fixed index annuities that are linked to something
Well, they're linked to something, whether they be the Standard & Poor Index, Dow Jones, Russell Index, the European markets, commodity markets, different kinds of industries, all kinds of different things that are available today. And they don't have to be annuities issued by insurance companies.
It could be something else.
These could be instruments guaranteed by banks that are linked to specific things rather than an interest rate. They work somewhat in the same way for a higher amount of deposits, but they're the things that we use and Lee makes use of through our managed money division, which Lee is the managing partner of.
All right, well, let's ask the managing partner of that division.
You think
Lee.
we should?
Yeah, we should.
Lee, are you
All
ready
right.
for this? Right.
So let's get back to that example of the 35% or 40, whatever it happens to be in stocks or whatever. Now, you had a list of things here under red money, and Stan just mentioned some hybrid instruments. How do you determine for that client which one of these they choose for their 35, 40%?
So if we go back to that other slide, you'll see at the bottom of that slide that we had on there before, no-so money and hope-so money. So
Okay, explain that.
If you're in the hope-so side, you hope that the monies do well. On the no-so side, which is the green money, we know that the monies are protected. So it's really not, it's probably the easiest question you've ever asked me. It's not a matter of me saying to you, you should have this. It's a matter of me saying to you, where are you most comfortable? How much of your money are you comfortable in having in hope-so money? And the rest of it then goes into no-so. How much are you comfortable with 100% at hope-so, or you don't want anything hope-so, you want also all no-so?
I mean, one of the questions we'll ask someone when they come into the office is, okay, based on where you are today, based on what's going on in the world today, based on, forget what's going on with the Phillies or the Eagles or
Right.
the 70s, but based on the financial markets, what are you comfortable with? What kind of returns are you comfortable with receiving? And then they'll give us a number and we say to you, is that realistic or not? And if it is, well, then our job is to come back to you with a variety of alternatives to give you that kind of a return and then measure the risk in relation to that.
So if they say, I want to get 15%,
We say we're
They're
not
in the
the
wrong
place.
office.
We're not the
Yeah.
place.
But-
Today, in today's environment.
in today's
that's-
environment, that's unrealistic.
Correct.
But you'll say to them, you can do this, which may get you this. It's not
Exactly.
going to be 15%, but they would probably be more in the hope-so money
Somewhat,
category, correct?
but there are some investments today where you can get 8, 9, 10, 11% as long as you understand what those investments are and the risk that there are with those kinds of investments. So if that fits into the client's goals and objectives and risk tolerance, and they've taken the stress test that allows them to participate in those kinds of things, they may make some sense for a portion of that person's money.
All right, we have plenty more to talk about here on the show. It is Molotsky on Money. We are here every week at this time. Tonight we're discussing the Rule of 100. It's one of the financial tools in the massive toolkit that Stan and Lee Molotsky have at the SHM Financial Group. We're going to explain more about that, answer some of your questions, so we invite you to stay with us. More Molotsky on Money right after these words.
Join Stan and Lee Molotsky and their guests for their next series of all-important workshops. It's a unique opportunity for you to meet Stan and Lee and the SHM Financial Group, as well as have your questions answered. All workshops are complimentary and include lunch or dinner. Do you know what your risk tolerance is when it comes to your investments? Do you know exactly what you have in your portfolio? The SHM Financial Group have developed a very important program called a financial stress test. It's simple, quick, and can help you in your future financial plans. Contact the SHM Financial Group to schedule it. Offices in Collingswood, Voorhees, and Lakehurst, New Jersey. Call 1-800-MONEY-SHM. That's 1-800-666-3974.
Welcome back to Molotsky on Money. I'm your host, John DeMasi, with Stan and Lee Molotsky. Every week at this time, we are here discussing a variety of financial issues. Tonight, we're discussing the Rule of 100, one of the tools, as I said, in the massive toolkit that Stan and Lee Molotsky have at the SHM Financial Group. From time to time, we have our number up on the screen. If you would like to talk to Stan or Lee in the office, you want to get more information on anything that we talk about, you can call them, you can email them, you can go to the website, you can find out a lot more and get more information. And of course, you sit down and meet with so many clients during the week. How do you have time to do this show?
It's a good question. We're working it in.
Okay, we were talking about green money. We've talked about this on the show, green money and red money, and we're going to show some different allocations here as we go through this particular segment of the show. But again, I guess the question that people have, Lee, is figuring out what makes sense for them. How can they be safe, secure, knowing that they're having growth and that they can sleep at night?
I mean, some people's objective is strictly all risk money. Some people's objective is all safe money. Some people's objective is, I really want to focus my attention to how much income can I get out of my assets. So it's really a matter of what the individual client's goals and objectives are, and the triangles that we use in trying to help someone understand where they are, we think is a really useful tool. So if you go back to the beginning, the first triangle up there, each individual fits on each of those 4 triangles depending upon their own objectives. So if you put the first triangle up there, if that's possible, the first triangle shows in income planning, if you're looking for income, the question we would have for you, are you looking for income right now?
You're never in the red, is what that's saying. You're never in the...
No, that's not what, actually,
Okay,
that's not what
explain
that's
that.
saying. What that means is someone who's looking for income right now would be in the income now category. Someone who's looking for income 3, 4, 5 years from now is in the income later category. And some people are at the point in their lives where
They
that
never
block of
need that
money,
money.
they
Okay.
really don't need income from that block of money. The objective for that block of money is strictly growth, which is not income, or simply passing along those monies to a beneficiary or 2 or 3.
It's like setting up buckets, if you want another
from
analogy.
From an income planning standpoint, we need to understand if that block of money fits in for income. The second triangle that we put up there, we also need to understand where that person fits in as far as risk is concerned. So are these monies low risk monies? Are these monies that you don't mind taking a moderate degree of risk on? Or are these monies that you're speaking about this evening or this afternoon or wherever time of day we get together with you, are these monies high risk? Is this a high risk block of money? And some of the monies can be all 3 parts of that triangle.
Some could be in the middle.
And a lot has to do with who is that money for? Is it for them? Is it for their sons and daughters? Or is it for their grandchildren? All of that determines what kinds of things the money goes into, and those things change. Sons and daughters get married. Unfortunately today, sons and daughters get divorced. All of those planning things that you're planning for, you have to make sure that you always have, and we make sure that with our clients, they all have some form of an exit strategy. In case things don't work out the way they want to, how they get out of what they're doing and then make an adjustment within the overall plan.
Can we go back to the third triangle?
Yes, we can do back. Can
So-
we get back to that third triangle?
Okay, so the
Taxation.
third triangle is, are these monies, are they taxable money? Are they tax-deferred money? Or is the objective tax-free income for life? So certain instruments that we use or certain asset categories are either taxable, that's non-qualified, tax-free, that's either municipal bonds or Roth IRAs, and we'll talk about Roth IRAs in a little bit, or are they tax-deferred like a regular IRA? An IRA is a tax-deferred instrument. The monies accumulate inside the IRA with no taxes, but come out taxable.
Sometimes it makes sense to pay the taxes now. Sometimes it makes sense to postpone or postpone, pay the taxes later, and it's an ongoing process, especially with this current administration and how they plan or lack of plan what's going on with the taxing structure. How do you do what you do when you do it, and you have to adjust based on what's going on within the cycle.
There's a lot of moving parts in this.
There has
There's
to be.
many moving parts.
That's the beauty of, I think, the planning process and what we can bring to the table as far as what and how it helps the individual.
Okay, we have some questions here from, again, these are from a variety of sources. Some come from our radio shows, some come from seminars, some come from just general email questions. This is from Richard in Hamilton, New Jersey. Richard says, I'm very confused about how to move around our money. My wife says I'm too conservative. I'm 71, she's 69. We're retired, need about $5,000 per month to live. We're currently what I consider 2 high-risk investments. She says we need more growth because we could live until we're in our 90s. That would be great, but I'm afraid. How do we figure this out?
Well, when they came into the office, we sat down with them and we basically looked at what they had, and what they had was more things at risk than what they really should have had based on what they're trying to accomplish and what their overall asset base was. So we made some suggestions, we made some different alternative planning for them that they're in the process of implementing, which will satisfy both him and her, that will give him basically more than the $5,000 a month, comes out to about $6,200 a month, and still gives them the safety and the protection of their asset base for themselves, and for this to be able to be passed on at some point to the children and the grandchildren.
I think one of the most interesting things we did for this couple was we ran what we call a Roth IRA analysis for them. It's about a 40-page document, which is really a tax document, and it explains to them if they took a portion, I think they took a portion of their $400,000 IRA and converted it to a Roth IRA, which enables them to receive tax-free income for the rest of their life from their Roth IRA. So if someone has an IRA, it's certainly something to consider for us to run this Roth IRA analysis for them.
We partnered with what we call the Gradient Tax Advisory Entity. They run the report, for us. It's a fee thing that we pay them to run the report. We currently offer it to clients on a complimentary basis. At some point, that may not be a complimentary thing, but
Okay.
Right now it's a complimentary.
We have another question before we time to squeeze one more in before we leave you tonight. This is from, this is Mildred in Vineland, New Jersey. Mildred says, I've been watching your show and I'm trying to learn, but I'm convinced that bonds are the safest investment at my age. I'm 85. My daughter says get out of bonds because my nest egg is dwindling. I told her to watch your show. Maybe she can learn some things. Is my daughter too old to learn?
Her daughter is 62, so she's
Okay.
just a young kid.
Okay.
So there's a lot of things that could be done, and in this particular case, the 85-year-old woman, the bond portfolio that she had, about 70% of it should be left alone because the maturities were anywhere from the next 3 to 7 years, so they're moderately safe. The others that had the longer maturities, that had the higher yields, were those that were the most vulnerable, and we agreed with her daughter, who was there as part of the interviewing process. And so the conclusion is that she should remove herself from those longer-term, higher yielding, more at-risk type things, and just park the money in the bank for a while and let's see what happens.
So in each case, each was partially right.
Oh yeah,
Okay.
that's normally the case.
Okay, all right.
Except when it's a husband and wife.
The wife is
Wife's
always
always
right.
right.
Except when
Okay.
it's a father and son. actually.
Then the father's always right. That's exactly right.
And with that, we're going to put the wraps on another edition of Molotsky on Money. Don't forget, if you have questions for Stan or Lee during the week, we've had the number up on the screen, the email address, the website. They'll be happy to talk to you. For Stan and Lee Molotsky, I'm your host, John DeMasi. Always a pleasure. Thanks for watching. We'll do it all over again next week at this same time. Take care.
Join Stan and Lee Molotsky and their guests for their next series of all-important workshops. It's a unique opportunity for you to meet Stan and Lee and the SHM Financial Group, as well as have your questions answered. All workshops are complimentary and include lunch or dinner. Call us to discuss the reverse mortgage concept. If you should decide to proceed, you're required to go through a 60-minute phone or office interview. We will provide you with a list of HUD counselors you can call who will provide you with the counseling. Call us at 1-855-HUD-REVERSE. That's 1-855-483-7383.